How does one figure that out? Just in your research phase, when you're researching your dividend companies, make sure to look at the annual reports, the quarterly reports, the business strategy, and understand their revenue, the composition of their revenue, and the percentage of their revenue that comes from different markets. And also just listen to the earnings calls, listen to the strategy. What are their plans to continue to expand globally? Hey everyone, this is Ian from ppcian.com, back with another video about dividend growth investing. I received a question on my YouTube channel just recently about international stocks. Someone asked me, hey Ian, do you incorporate international stocks into your dividend portfolio? You're building a portfolio to drive an increasing stream of passive income over time, a stream of passive income that will one day surpass your living expenses. Ian, do you only own US-based stocks, US-centric stocks, or do you diversify globally? So I want to answer that question today. In fact, I do diversify globally, but I diversify globally in a variety of ways. So I want to share some of the perspective in some of the ways in which I diversify today. So most important point here is that question is spot on. Emerging markets right now are the growth markets globally. And in particular, I watch some economics videos, some economic seminars and conferences, and one of the trends that has emerged with these emerging markets is that India and Africa in particular, those two markets, they're doing really well. They'll continue to grow. They're going to continue to thrive over time. And it seems that the popular opinion with economists right now is that India is the growth market right now. And looking another 10, 20 years out, Africa is going to be a huge growth market as well. But of course, there are a lot of emerging growth markets right now internationally. And as an investor, one wants to participate in those markets because it's going to add some fuel to the growth rate of your portfolio, to the earnings stream, the revenue stream of the companies that you own, and obviously the ability for those companies to pay you and me dividends. So that's something at a high level that I keep in mind with my dividend growth portfolio. Now, how do I invest in these emerging markets? Well, one thing to be cognizant of is many, if not most, of the large blue chip companies that are listed in the United States, whether it be the Dow Jones Industrial Average or the S&P 500, these big market cap companies, a lot of them already have international exposure. So you may be thinking, I have to go out of the United States. I have to buy a company that's based somewhere else, like maybe it's based in London, maybe it's based in in Amsterdam. You kind of, many people, and myself included, kind of have that perspective that, you know, maybe I have to go out of the US to get that international exposure. Well, that is just not true. In fact, if you buy companies, many of the companies that are based here right in the United States, that maybe they even got started in the United States, these companies are smart. They have realized that to continue to grow, they need to expand globally. And so many of the big mega cap companies in the United States already give you that international exposure. They already give you that emerging markets exposure. And how does one figure that out? Just in your research phase, when you're researching your dividend companies, make sure to look at the annual reports, the quarterly reports, the business strategy, and understand their revenue, the composition of their revenue, and the percentage of their revenue that comes from different markets. And also just listen to the earnings calls, listen to the strategy. What are their plans to continue to expand globally? So most of the companies that I own in my own portfolio, they're US based. However, I have gone out and bought a few companies that are based internationally as well. And so it's okay to throw in a few, I like to call these pure play international companies, because these international companies, they're actually based internationally. They're not based in the US. A large portion of their sales, if not all of their sales, come internationally. Obviously, some of the companies based internationally, they also diversify in the United States, so they're selling to the US as well. So that's what's interesting. Whether you buy a company based in the US or based internationally, oftentimes you get a similar basket and composition of revenue. But again, sometimes I like to throw in a few pure play international companies, and I do own a few of those. And a few things to keep in mind with those. First and foremost, with a pure play, Be careful of withholdings. A pure play oftentimes is on a different dividend schedule than United States companies. Most companies based in the US pay dividends quarterly. That's 4 times per year. That's great for an income investor like you and me because we can get our dividend payments quarterly. They're predictable, they come in regularly, and it helps us pay our bills because we're using the money. I'm not using it now, but eventually I'll be using that money to pay my bills. And so coming in quarterly is great. International companies oftentimes are based on a different schedule. Sometimes I've seen them pay dividends once per year. Most of the time it's twice per year. It's semi-annually. So just something to be aware of. And sometimes it's a different amount. They'll pay kind of a smaller dividend up front, the first installment, and then the latter one, it's really based on performance. It'll be big. Well, both are based on performance, but the latter one, the second one, will be bigger. And so that makes just the income stream a little less predictable. If you're using these dividend payments to live off of, and you're only getting them twice a year and they come in different amounts, it's harder to budget. Again, that's not a problem for me right now, but just thinking about the long term of things, that's why I compose my portfolio mostly of US-based companies, but I've thrown in a few of these international pure plays, and it kind of all smooths out. The dividend income all smooths out because I own enough positions where it all blends together, and it comes in reasonably, in a reasonable, predictable fashion throughout the course of the year. So something else to keep in mind with international companies is withholdings. Typically, if you are not, and again, I'm not a tax advisor, and this is not tax advice, this is just kind of just for entertainment purposes, but just for my personal wanderings, I found that in the United States, if you are not subject to backup withholding, you will get all of the dividend. You're going to get all of the dividends when they're paid out, and come tax time, when you do your tax return, that's when you're subject to dividend taxation. You have to pay taxes on those dividends. With international companies in many countries, you oftentimes have a withholding. What will happen is the international government of the other country will withhold money, and sometimes it's quite high. Now, when you file your taxes in the United States, you can claim that as a credit and you can get those withholdings back, but the fact of the matter is that creates bureaucracy, it creates more work, more record keeping, and quite frankly, think of this scenario. In the long run, maybe you don't need to file taxes. Maybe you live in a really low income or low cost of living state. Maybe you earn enough dividend income to cover your living expenses, but it's not an astronomical amount of income. It's not enough where you're subject to filing taxes. Well, in that case, if you own a bunch of international companies and they're withholding a big portion of your dividends, to claim that money back and get it back, you need to file taxes. Again, if you're not in a situation where you're required to file taxes, that just creates an issue. See, I don't envision I'll be in that case, but I'm just pointing it out because I know a lot of dividend investors, they're optimizing themselves in a variety of ways. They're optimizing their living expenses, their dividends, and a lot of dividend investors do have a dream of living in a state within the United States where the cost of living is very low, and therefore the amount of dividend income to cover expenses doesn't need to be astronomically high. So if you are in that case, just think about that, because if you are buying international stocks that require international withholding, it could just create a little bit more complexity in your life, and unexpected complexity if you weren't considering that up front. Now, with the United Kingdom, as of now, the US has a tax treaty with them. So if you do own international stocks that are based out of the UK, there is no international withholding. So that's just something to keep in mind as well. Like maybe you do want to go with a few pure play international companies, but you don't necessarily want the withholding. You could look first maybe at UK-based stocks, and I think that's a place that's great to start, and I do own some of those in my portfolio, so something worth noting. Now, I would, actually that's all I have written down for today. So I just to really wrap things up today, this is PPC Ian. We're talking about dividend growth investing. We're talking about investing for dividends, for cash flow, for income. And just in terms of my own experience, I own a variety of stocks in my portfolio. Most are US based, and many of those US based stocks have great international exposure, great emerging markets exposure. But to get even more international exposure, I have picked up a few pure play international stocks that are companies that are literally based in other countries. And there's certainly some considerations that go into that, mainly the withholding and the different dividend schedule. So thank you so much for watching. Thank you for the questions. I appreciate all the questions that roll in. I have a ton of questions, a big backlog actually of questions that are going to fuel future PPC and videos here on YouTube. Before I leave today, I just want to let you know that this is not investment advice. I'm not a licensed investment advisor. I am just sharing my passion here on YouTube. I am passionate about investing for dividends, and so this is for fun and entertainment. If you are going to go out there and make some financial decisions, please speak with a licensed financial advisor. Thank you so much for watching. I will see you in the next dividend investing video.